Great. So let's get started. Good morning, good afternoon, and good evening. I'm Diana, and I'm the Head of Research and Sustainability at GBBC. It's a pleasure today to welcome you to GBBC's Virtual Members Forum. It is a bi-weekly webinar showcasing the innovative work of our members around the world. And today our topic is on the evolution of blockchain for financial services, a journey leading from RWA, TVL, which means really leading real-world assets, the representation of real-world assets on a blockchain, and the metric of total value locked. And today we will be joined by Anthony Moro, the CEO of Provenance Blockchain Foundation. This presentation will explore the evolution of blockchain specifically designed for real-world financial assets in its journey to becoming the largest blockchain of RWAs. Anthony will elucidate what distinguishes a blockchain built for financial services from general-purpose blockchains. He will highlight pivotal use cases and their outcomes, examine current trends in RWA tokenization, and share insights on the industry's projected growth to $16 trillion tokenized in real-world assets over the next 7 years. Before we begin, I would like to also introduce Anthony as CEO of Provenance Blockchain Foundation. He joined the foundation in July of 2022 to lead the expansion of Provenance Blockchain's ecosystem and to enable financial institutions globally to realize the benefits of blockchain. Previously, Anthony held various senior executive roles over his 2-decade career at BNY Mellon, including managing one of BNY Mellon's most profitable businesses, the DR Group, which made up over 800 issuer relationships from 73 countries. More recently, Anthony was president of ROX Financial, an asset management fintech company focused on democratizing access to commercial real estate through innovative NYSE and listed REIT securities. In addition to his role at Providence Blockchain Foundation, Anthony is also an advisor to Banyan and Zecurity. So ultimately, we welcome to the audience, we welcome your questions at any point during today's presentation. Please submit them at the bottom of your Zoom screen in the Q&A button, and we will take them after the presentation. Thank you, Anthony, for joining us, and I will hand things over to you now to begin.
Wow, thanks, Diana. I think that was the best introduction I've ever had in my life, so kudos to you. Thank you for that. And I'd also really like to thank the GBBC for the introduction. We've been members certainly since I've been at the Providence Blockchain Foundation, and you guys throw wonderful events, give great intelligence, and kudos to what you guys are doing as well. We're longtime supporters. So let's dive right into it. It's no secret that today's financial services are built upon complex, time-consuming, and expensive intermediation. Most transactions require multiple service providers, and each take a small fee to move the process one step further. And a lot of the intermediation is justified. For instance, separate accounts, exchanges, clearing agents, and custodians ensure a proper audit trail is kept, and they allow for appropriate risk and control procedures. Ultimately, all this intermediation exists solely to bring a redundant amount of trust into the financial system and to protect investors from bad actors. Now, imagine if you could ensure that investors are appropriately protected while significantly increasing transaction speed and materially reducing transaction cost. This is the new value proposition of blockchain and financial services. Blockchain does two things particularly well. It displaces trust with truth through an immutable public registry. And two, it enables real-time, riskless, bilateral transactions without intermediaries. When the new financial services system is cheaper, faster, and safer than the existing one, everyone wins, except, of course, the incumbent intermediaries. Despite all the crypto industry hype that we hear in the papers every day, the financial services blockchain technology and adoption is still in its very early stages. Legacy bank and asset management systems that are trusted and ubiquitous are also antiquated, complex, and expensive. And we think that it's inevitable that properly built blockchain networks that reduce intermediation, increase speed, lower cost, and improve safety will materially change the industry and impact $12 trillion of existing industry revenue. Some specific functional areas of improvement will include trading, where blockchain can displace trust with truth through an immutable public registry that enables real-time riskless transactions, as we just spoke about. But also security, where clearing and settlement of securities can be entirely automated. And finally, access, where blockchain can democratize availability of new and existing investment products, putting an end to the traditional 60-40 stock and bond portfolio and allowing investors to invest like the typical Yale University endowment, where you have access to a wide variety of alternative investments. So once again, we think the winning formula is simple. Bring solutions that are cheaper, faster, and very importantly, safer than existing TradFi systems. And while the formula is simple, the transformation is going to be incredibly complex and highly disruptive, and it's going to take a decade or more to play out. So there are several estimates of potential market value of digital assets, but all the pundits agree that the opportunity is in the tens of trillions of dollars by 2030, as home equity, bonds, and other asset classes all come on chain. And while $24 trillion, as we see here in this slide, is a very large number, you have to remember it's still just a fraction of the $700 trillion of investable assets globally to come and play over the next several decades. All of these assets will need to be ledgered, registered, and exchanged on blockchain networks that support a diverse range of asset classes, issuers, and investors, while acting as a good control location and mitigating risk across the network. So which layer one blockchains will dominate this new industry? Well, this is the multi-trillion-dollar question. For an answer, we can look to traditional financial services for guidance. From credit cards to custody banks, we know that a global oligopoly of providers inevitably evolves due to security, interoperability, and regulatory pressures. We think we'll see the same dynamics in DeFi, and a very small number of public blockchains will be used to register, ledger, and exchange the world's financial assets. Within this construct, we believe the Provenance blockchain is perfectly positioned because it's the only major layer one purpose-built for financial services. So what does this mean? It means Providence is a public proof-of-stake layer one blockchain built for regulated financial services use cases. Our mainnet was developed with a unique hybrid model that offers the best attributes of the public permissionless blockchains like Ethereum and Solana and Avalanche, and the private permissioned DLTs like Hyperledger, R3, and Digital Asset. Simply, Provenance Blockchain's hybrid structure allows it to benefit from public blockchain innovation and open source accessibility while enabling the robust security and good control location features that regulated financial services require. Moreover, while most financial services use cases are well suited for Provenance's public mainnet, many large banks and asset managers have specific asset protection requirements driven by their risk and compliance teams and by their regulators. Provenance's optional private and permissioned zones offer the same APIs and capabilities as mainnet, while allowing operators to have complete control over access and validators and tokenomics. Zone operators also have a seamless interoperability with the public mainnet at a time of their choosing, which serves to future-proof their asset issuance. As a result of Provenance's focus, it has grown to become the world's largest layer one public blockchain as measured by real-world assets, with more than $11 billion of total value locked and more than $30 billion of transactions. Our RWA total is around 4 times larger than the total amount of RWAs on all other public blockchains combined. And as the RWA opportunity continues to capture increased industry attention, our leadership position will only grow in importance. So Provenance's superpower is that financial services capabilities like governance, identity, privacy, exchange, and interoperability are all built directly into our protocol. Essentially, asset creators can program all of the individual attributes they need to meet operational or regulatory requirements at the time of the creation. By materially reducing or even eliminating third-party smart contracts, Providence significantly de-risks financial services applications and eliminates the Jenga tower of risk inherent in other generic blockchains. Every other blockchain protocol was purpose-built to be general purpose. Specifically, to perform any complex function, builders need to integrate several third-party smart contract functions to facilitate their desired use case, be it gaming or meme coins or metaverse or regulated financial services. As blockchain networks increase their focus on real-world assets, the landscape is getting confusing. A proliferation of dozens of security issuance standards on the EVM-compatible blockchains such as ERC-20 or 721 or 1400 or 3643 further stresses the system. We think that each smart contract introduces complications including counterparty risk, upgrade compatibility risk, cybersecurity risk, increased expense, and vendor management. And these complications inject risk and hinder financial services adoption at scale. Providence's architecture more closely mimics the good control location inherent in TradFi custody banks and brokerage networks. So to dive a little bit deeper in some of those core capabilities, first, Providence has smart tokenization capabilities called markers that offer the ability to toggle on or off things like transfer restrictions or programmatic tendering, restoration in case of loss, escheatment, abandonment, and other functions that are required by securities law. Next, we know identity is crucial in regulated financial services, and Providence supports functions like KYC, AML attestation, and signature authorizations, all directly on-chain with immutable records. Data privacy is also an absolute requirement for a public blockchain focused on financial services, and Providence allows the ability to store personal identifiable information off-chain in an encrypted object store. Our exchange modules are unique in that they offer in-place escrow and execution. And then finally, Cosmos is recognized as the most interoperable blockchain, allowing issuers to move assets between mainnet and private zones in a safe and compliant manner. So we spoke a bit about why we believe blockchain technology is the most transformative financial services technology of our lifetime. And we also discussed a bit that the transformation is going to be incredibly complex. The revolution will be iterative. It will come market by market and asset class by asset class. We're in a working group led by McKinsey with a number of leading banks and asset managers. And after a good amount of debate, we agreed on the construct of this slide, which shows the specific asset classes most likely to adopt tokenization. And I'll touch on a few now. For example, we think the first multi-trillion-dollar financial market to be disrupted by blockchain will be consumer lending and securitization. Today, there's around $13 trillion of annual consumer lending production in the US across mortgages, HELOCs, auto, and student loans. Each category has different characteristics, but in the aggregate, there is an enormous amount of cost and efficiency tied up in intermediated processes. So look for blockchain disruption throughout the asset lifecycle, from point of sale to loan origination, to custody administration, to servicing the marketplace, to securitization. Figure Technologies has been the industry's most successful issuer of digitally native loans by using blockchain's technology to make the origination to warehouse to securitization process cheaper, faster, and safer than the traditional workflow. And we'll double click on this in a minute. Next, we're excited about FX and cash. Longer term, we see payments disruption. Firms like Visa and MasterCard and PayPal have dominated payments, but at their core, they're basically intermediaries in a two-party transaction. Blockchain provides a path to disintermediate them out by supporting bilateral transactions among any two counterparties. When properly regulated blockchain technology takes hold of this industry, moving money will become as simple and as cheap as sending an email or swiping a phone, and consumers will save, importantly, the 3% credit card fee that really nobody likes. More importantly, in the FX and cash vertical, we see a fairly broad stablecoin adoption. Today, there is around $150 billion of stablecoin value outstanding, but the product's growth has stalled because current stablecoin structures don't provide yield, they have issuer counterparty risk, and they operate in an ambiguous regulatory structure. We think we'll soon see an SEC-registered yielding stablecoin that can be used broadly for payments, asset settlement, and trade peer-to-peer. When this happens, broad adoption will come quickly, and we think cash will be the first trillion-dollar blockchain asset class. Finally, we have probably the most popular potential blockchain asset class, public equities. Today, public equities are one of the most intermediated assets in financial services. And while they're definitely becoming more efficient, it still takes 8 separate entities a full business day, now 1 business day down from 2 last week, to settle 100 shares of Amazon. Blockchain promises instant bilateral trading and can send the $50 billion of street capital that DTCC holds every day for settlement risk back into investors' pockets. Unfortunately, though, for blockchain adoption, investors like the experience of free trading on their Schwab or Merrill Lynch accounts, and the various incumbents are deeply entrenched. So there's a lower probability that we'll buy those Amazon shares on blockchain anytime soon. So as I said, this is a good review of asset class by asset class, showing the way forward. I'll just also note that there's very intelligent and well-financed teams working to disrupt each vertical, and the future is going to be very interesting. So Providence, as we spoke about, has a material lead in financial services blockchain adoption. Providence has a fast-growing ecosystem of diverse asset issuers, servicers, infrastructure developers, and protocol validators. The flywheel on Providence is spinning, powered by the evangelical passion of network participants, which range, as I said, from tier 1 banks to early-stage fintechs. The network started when Figure launched its lending business in 2008. Led by Mike Cagney and Juno, Figure Lending, now called Figure Technology Solutions, has since disrupted residential lending by building a Providence blockchain-enabled home equity line of credit business that is now the largest non-bank lender in the US. In 2023, most of the largest home equity lenders, including Movement Mortgage, HomePoint, and Guaranteed Rate, were also using the Figure platform on Providence, and together they issued more than 6% of all HELOCs in the US. This makes HELOCs the first and so far only asset class to be disrupted materially by blockchain. So far in 2024, Figure Technology Solutions is ledgering more than $500 million per month in HELOC origination, and they recently announced a private capital ecosystem that includes a reworked mortgage issuance platform that will bring massive efficiencies across several private credit markets. The Figure solution also shows the way forward for a blockchain-based business. The borrower-facing workflow has an intuitive internet-based user experience with a blockchain middle and back office. Loan applicants don't know they're interacting with blockchain. They don't need wallets, and they don't need to hold crypto. The securitizations that come out of the other end are fully rated by DBRS Morningstar, and the investment banks include Goldman Sachs and JP Morgan and BNY Mellon, so proper traditional financial services leaning into blockchain. The primary blockchain benefits are significantly increased speed of execution and material operational savings that are more than 150 basis points less expensive than the traditional process. The savings can increase profits to the lenders and, very importantly, lower rates for the borrowers. Once again, when the transactions are cheaper, faster, and safer, everyone wins, except, of course, for the incumbent intermediaries. The other two big circles on the chart here are Figure Markets, which is a Providence blockchain-based decentralized platform focused on trading, borrowing, and investing in a range of assets. They recently launched a new kind of digital marketplace combining centralized exchange liquidity with the security and asset control provided by a decentralized platform. In addition to a range of crypto, Figure Markets trades real-world assets like consumer credit, public equity, fixed income, and alts, and supports cross-collateralization of all assets as they create a marketplace for everything digital. And then finally, Providence Blockchain Labs is just spun out of the Providence Blockchain Foundation and is building a suite of foundational infrastructure SaaS products that enable asset issuers and servicers to efficiently transact on the Providence blockchain. And Prov Labs will leverage the roadmap and the institutional grade infrastructure used by Figure and JP Morgan and Apollo and others to help asset originators quickly scale with a wide range of new use cases. Prov Labs' first engagement happened late last year, was the latest iteration of the Monetary Authority of Singapore's Project Guardian. In November, JP Morgan's Onyx digital asset team, in collaboration with Apollo and WisdomTree, enabled fund managers to tokenize funds onto private permissioned instances of Provenance Blockchain, JP Morgan's Onyx, and Avalanche. JP Morgan's wealth managers were then able to buy, sell, and rebalance thousands of separately managed account positions across 3 interoperable blockchains according to their model portfolio allocations. The press described the project as the holy grail of capital markets blockchain, and they touted how this next generation solution could reshape the $5.5 trillion portfolio management business and democratize access to alternative investments. JP Morgan shared that their implementation reduced more than 3,000 separately managed account operations to one automated process. It reduced portfolio fees approximately 20% as a result of reduced cash drag through faster programmatic settlement, and it enabled $400 billion annual revenue opportunity for the broader alternative asset management industry. It was a very exciting project when we worked with JP Morgan and Apollo and Oasis Pro and Axelar and others, because private funds are one of the largest and most promising blockchain asset classes. From private equity to debt to real estate, many fund asset managers across the industry saw Project Guardian as a compelling reason to digitize, and they now view Providence as the industry-leading standard blockchain. So a quick word on how the foundation and labs interact. So like most public blockchains, Providence is centered on a non-profit entity, in this case, the Provenance Blockchain Foundation, whose core mission is to help build the new operating system for the modern financial services industry. The foundation is a decentralized organization that supports the development of the Providence blockchain ecosystem through education and governance, a $50 million grant program, developer and validator support, and open source protocol improvements. And as discussed, Prov Labs recently spun out as a for-profit company that specifically helps TradFi firms and fintechs bring their assets onto Providence. Prov Labs offers engineering and capital markets professional services and a robust managed software as a service business focused on providing foundational application layer infrastructure necessary to digitize institutional assets. Taking a quick step back and looking at some of the things that Providence Blockchain has accomplished over its history, I mentioned it was launched in 2018. In this case, as a private and permissions instance of Hyperledger. In 2021, it was rebuilt in its current form with the Cosmos SDK, and the Providence Blockchain Foundation was launched. The network and Figure technologies in particular have been at the forefront of innovation since its launch. And some industry firsts include the first blockchain native consumer loan origination, the first asset-backed securitization, the first rated asset-backed securitization, the first REIT, the first mortgages, the first HELOCs, the first digitally native cap table, and the first bank-issued stablecoins. So a lot of activity in the network, continues to innovate and operating in the right construct. Looking specifically at the performance of the Providence blockchain, this is statistics from the first quarter of 2024, was the most active in the history of the Providence blockchain. Transactions were up 7% quarter over quarter to an all-time high of more than 1.5 million. Total fees paid in the network also grew materially. When expressed in USD, they were up 44% quarter over quarter. The network ended the first quarter with $10.4 billion in total value locked. That number is now well over $11 billion. The metric was up more than $1 billion quarter over quarter. And during the quarter, the Providence blockchain became only the second public blockchain after Ethereum to cross the $10 billion TVL threshold. And as we spoke about, all of Providence's TVL consists of real-world assets, making Providence by far the world's largest blockchain as measured by that metric. And to put Providence's quarterly increase in perspective, the $1 billion added during the quarter is roughly equal in size to all the tokenized treasuries, bonds, and cash equivalents that are currently outstanding across all blockchain platforms. Our utility token is called Hash. Hash is used to pay transaction fees for staking and as a voting mechanism in governance. The hash price floats and its value is driven by usage. There's a fixed supply of 100 billion hash, and hash can't be created or destroyed. Of course, hash is much less well known than many public blockchain tokens, because the current version of hash has never been sold in an ICO and isn't listed on any centralized marketplaces. So as you've learned, our community to date has consisted almost entirely of institutional use cases, and there haven't really been any real retail use cases. The recent launch of Figure Markets, though, changes this. And Figure Markets' decentralized exchange will be both institutional and retail facing. And they've just launched the exchange, and it will be the first proper marketplace where retail investors can buy, as well as institutions can buy and sell hash. We're planning also to list hash on some of the more well-known centralized exchanges in the coming months. And we have some very detailed plans to build visibility across the traditional crypto channels in 2024. So it's about to get a lot more exciting here at the Providence Foundation. So watch this space. And my last slide, we've covered a lot, but we hope we've come away with a good understanding on how Providence has built a blockchain specifically designed for real-world assets. We welcome you to connect with us on email or Telegram or Discord or GitHub or LinkedIn with your feedback, your ideas, and most importantly, introductions to potential asset issuers and partners. We're all building here the new operating system for financial services, and we've got great momentum. It's an incredibly exciting time for us, and we hope you'll join our ecosystem in some way, shape, or form. And here's a bunch of links where you can find a lot more information. Ready for some Q&A, guys.
Great. Thank you so much, Anthony. This has been a wonderful presentation, and we really appreciate you sharing your insights about the growth of Provenance Blockchain Foundation, the opportunities with real-world asset tokenization, total value locked as a metric, and everything else that you're building as an ecosystem around it. For those who joined later, I'm Diana, Head of Research and Sustainability at GBBC, and we're going to take questions now. So getting started, we've had a few registrants send in questions ahead of time. We've had people send in questions now, and we'll do a combination. So let's get started with a prior question, which is on, please discuss the implications of AI and quantum with blockchain solutions. And I assume, like, especially for financial services.
Yeah.
I would assume this person is looking into financial products.
Yeah, so this is they go together like peanut butter and jelly. We're really excited about the AI implications. We've disclosed a partnership that we have with Microsoft and their AI team, putting Providence data in what's called a data lake and using AI to model out answers. And let me give you a very concrete example. So in the 2008 mortgage crisis, part of the problem was, if you saw the movie The Big Short, no one knew what assets were in each mortgage securitization. These things are made up of thousands of individual mortgages. They each have different payment schedules, and the servicing firms behind them are able to tell you that any particular mortgage is in default. By that time the information gets through to the appropriate parties, it might be 60 or 90 days after the mortgage is in default. And lack of information was a big reason the financial crisis accelerated the way it did. Using AI and having mortgage and home equity line of credit information in a data lake, you'll be able to see in real time which borrowers in which parts of the country with which credit scores, with which LTVs are distressed and which aren't. And because real-time payments are incredibly possible in what we're doing, and AI can sit on top of that, it can monitor the market in real time. So you can hedge, you can get in front of, you can protect investments, assets, structures by using AI. So that's just a small drop of the things that we're looking at. The AI and blockchain, sharing a ledger, sharing information in a, of course, properly permissioned manner where you're not exposing PII to parties that aren't able to see it. If done right, we can start to make financial markets extremely efficient and, frankly, remove a significant amount of risk from financial products, including financial products that could, theoretically, bring down the economy the way the great financial crisis happened in 2007, 8, 9.
Fantastic, very well thought out, and it's something that we're seeing a lot at GBBC, the convergence of different emerging technologies where blockchain as a record of data can be a sense of trusted data going into the AI algorithms and a range of different use cases and opportunities. It's great to see how you're making it real. Here we have a working group on blockchain and AI, and there's a lot of excitement and conversation going on this topic. Next question, how would you rate the risk management capabilities of your product as opposed to the competition? Do you have creditable competition in this area? If so, what does it look like? Who are they? And what would you be able to say about this?
Sure, great question. So two answers, I think, or two areas of my answer. So first is you have to separate private and permissioned DLT from public blockchain. And I talked a little bit about this. Many early use cases in blockchain were private and permissioned DLTs, digital ledger technology. And it's an iterative step from a centralized database, a centralized DLT. The promise of blockchain, in my opinion, and I think this is one today, the future of blockchain for sure, is a public and open source blockchain where multiple parties can contribute to the protocol, can ensure good governance, can ensure sanctity of code. So the first risk management tack that I'll take is we believe a public and open source blockchain is the right risk management structure. You've got validators, dozens, scores, hundreds of validators in multiple countries around the world, a network that really can't ever be hacked. If managed properly, it shouldn't ever go down either. And it's so decentralized that nobody owns it, which is also inherently risk, important from a risk perspective. And then two, I would add on top of that, how is the network built? And this is where we had the Jenga tower of risk of smart contracts. My having sat for in more risk meetings than you could imagine during my 20 years at BNY Mellon, I can tell you that there are committees that look at each atomic step of each transaction and determine the risk of assets at risk during each step of the transactions. And I honestly don't see how regulated banks and large asset managers get comfortable with the counterparty risk, the cyber risk, the compatibility risk of smart contracts in the way that they're constructed today. So the way that Providence mitigates that is we build all those functions directly into the protocol. So you can spin up a bond or a HELOC asset in Providence without using a single smart contract, right? And you can trade that asset also without using a single smart contract. And we just think that's safer. When you use a smart contract, for instance, to trade an asset, the value of the asset goes from your wallet to the smart contract's wallet. If you get a dividend or you get an interest payment, it's ambiguous as to who owns it because you've given up your ownership to the smart contract. The smart contract owner goes out of business when he's holding assets. When you get them back, those counterparty risks are just unacceptable to most banks. And I think that's a big reason why we haven't had the scaling that we've seen on the general purpose blockchains. We haven't had the scaling that we've wanted on the general purpose blockchains. I think for financial services, it's really important that there's a purpose-built blockchain. I would say the same thing for the metaverse and for games and for meme coins. Purpose-built blockchains will be dominant for each segment of the blockchain industry. A generic all-purpose blockchain that does everything for everyone, is all things to all people. I don't see how that scales in financial services.
Yeah. Well, thank you. Thank you for your answer and your insight. Next question is, can you compare Provenance Blockchain to the Canton network, or if there's any other networks that you'd like to include in that?
Yeah, so Canton's a great network. They have a wide variety of financial services adoption. From what I know about it, it is a private and permissioned DLT, digital ledger technology. And so it's a very different construct than an open source public layer one. Banks and asset managers in this environment today are, I agree, more comfortable in a private and permissioned DLT. Maybe their internal regulators or external regulators insist that they don't use public blockchain technology. We've seen that. I think it's diminishing, but we've seen that in the past. Again, I think the future is public, but maybe the present in some of those banks and asset managers is private and permissioned. The way that Providence mitigates that is we have what we call zones. And in a zone, this is what JP Morgan used in that Project Guardian slide that I spoke about. They spun up a private and permissioned instance, meaning they took the exact same software that the mainnet runs on, and they ran it among a validator set that they controlled. They controlled the tokenomics, they controlled the governance, they controlled the permissioning, which essentially looks like a private and permissioned DLT, but it's fully interoperable with mainnet, meaning you can build in the private and permissioned DLT, and then when your regulators allow, you can efficiently and safely transfer back over to mainnet where all the action will be. So yeah, different constructs than Canton. Canton's a great network. They've got a lot of banks using it right now, but I think it's more of an iterative step to public and open source.
What about fraud risk? If an institution claims to tokenize an orange, but the underlying asset is really an apple, how does your new platform improve upon this risk management issue?
I love this question. So what we try to stay focused on is digitally native asset creation. And let me tell you what that is. So we have a partner, I'm not going to say who it is, who tokenizes a process, and not dissimilar to that, is the IBM Strawberry that they talk about in their blockchain-based strawberry to store process. Is that the strawberry that they picked? Hard to say, right? Likewise, there's a use case where 3 different people would take a dipstick and put it in an oil tank, and someone would take a picture of it and they'd upload that picture to the blockchain. These are not digitally native blockchain use cases. So you can't eliminate fraud at the source of when an asset exists in the real world and you try to tokenize it via a double ledger. The only way you can ensure the asset is real. The only way you can replace trust with truth, as I spoke about in the first slide, is by having a digitally native asset. And so Bitcoin is a perfect example of a digitally native asset. It doesn't exist anywhere else. If you own it on chain, you own it in real life. You have the value of it. It can sit in your wallet. It can follow you around everywhere else. Now, of course, not all assets are Bitcoin, but Bitcoin being a digitally native asset shows us the way to spin up financial assets on blockchain. And a mortgage, a HELOC, all these credit products, eventually equities and bonds, all these can be digitally native, meaning the only place they exist is on chain. There is no paper version of it. There is no DTC version of it. There is no Charles Schwab version of it. It only exists on chain. So that's the future we're working towards. That definitely is not the present. And there's going to be a lot of hybrid structures to get us from where we are today to where we should be. But the future is clearly digitally native assets.
Well, building upon this, are there any comparative studies with other similar blockchains? And what are your thoughts?
Comparative studies. The industry is still new. There isn't, so I think the market will tell us who wins. The market, as I said, will be an oligopoly of, the public layer one blockchain market will be an oligopoly of providers. And I think that might be, 2, 3, 4, 5 public layer ones that ledger the world's financial assets. Again, I think other assets or other blockchain use cases will have their own layer ones. It's not really competitive yet. I think we might in the future, but there's $700 trillion of financial assets that we're looking to tokenize over the next couple of decades. So yeah, I like to say there's no competition in what we're doing yet. There might be down the road, but the industry is so new. There's so few assets on chain. Builders will pick, I think, the networks that are cheaper, faster, which everybody does, but also safer, which very few people do, or blockchains do.
What about hash? Do you believe that it has the potential to compete with ETH, Bitcoin, etc.?
Good question. Hard to answer. I'll talk about hash. So hash is massively disruptive to the financial system. There's $12.5 trillion in financial system revenue globally. I'd also add that we're destroying market cap from others, from the intermediaries, because things like escrow agent, paying agent, repo agent, these are financial services functions that don't need to exist. They can be replaced by the blockchain. So when you can replace reconciliation, at Bank of New York, we had teams and teams of people who did reconciliation. You don't need to do that in blockchain. So we're disrupting it pretty materially. Value will accrue to the hash token as more hash tokens are used. And I showed some statistics about how fees paid into the Providence blockchain are increasing pretty rapidly. I think once we list hash, it'll be more well known. So we're very bullish about the future of hash, is what I'll say.
Wonderful. What about, can you tell us more about the timeline on the cash and payment disruption that you are working on? And specifically, are you doing any mortgages in Canada?
Okay. So cash and payment disruption, as I mentioned, the current construct of stable coins has sort of stalled out. There's about $150 billion of stable coin. That number really hasn't moved for the last 18 months or 2 years. And you would think that it has, USDC has actually lost value. USDT has increased value. You can debate why that is, but some of it is there isn't a proper regulatory construct for stablecoins, certainly in the US. I think once we get a yielding stablecoin that's registered with the SEC, the industry will explode. And as I mentioned, I think cash NFX will be the first $1 trillion blockchain asset class. I think that will happen in the next 2 years as things grow. And then, are you doing any mortgages in Canada? I'll just add that we are the blockchain layer. That's it. Builders can build on top of the Provenance blockchain to put the functions on. So we would certainly welcome anyone doing mortgages in Canada. I know there's a firm called Infinio that does life insurance, but they're tangential to mortgages and they're Canadian based. But builders build specific products. We're just looking after the protocol.
Great. Moving on to a legal background and the interest in getting more involved in the RWA process. Are there any major compliance or KYC pain points that you would have seen that would require deployment and on-chain solutions to help get to the $10 trillion of total value locked in the years ahead?
Yeah,
Tell
great.
us more.
Another great question. So, I mean, everything that exists in the traditional financial world needs to move on chain. There are some really good onboarding KYC, AML providers in the traditional financial world. We do need them to move on chain. Once they do move on chain, there's the concept of the soul bound token. So you can ensure that your KYC is up to date. It's a universal passport that has all of your accreditation, all of your identity, control of that universal passport is important to ensure that you are the one who controls it. You only give access to those who you want to give access to, because obviously PII, personally identifiable information, is super important, control of it. So we're looking to bring everything that exists in traditional financial services onto the blockchain. Now, of course, the blockchain uses pseudonymized ledgers, right? And you still will need something that is linked to that, held in what we call an encrypted object store off-chain. So getting the risk and control structure right is crucial. We're not there yet. I wouldn't even say we're close to where we're going to be in 5 years. I know there's a lot of smart people working on it, and we're excited to see where it goes.
Excellent. What about bankruptcy risk? Does Providence itself have bankruptcy risk? Is Providence a source of intermediary counterparty risk? And have you solved that?
So the Providence Blockchain Foundation is a non-stock, not-for-profit. It does not own the network, very importantly. The network is open source and updated by the community. So again, no one owns it. Updates are voted on by governance. So the larger holders of hash are able to vote on how the upgrades are enacted. And hash is largely owned by the validators and a community of large financial services providers. Of course, Figure Technologies, but also very importantly, Franklin Templeton and Apollo are large owners of hash. They have a large say in how the network continues to evolve. And I would just say, if someone came along and wanted to build a metaverse platform on Providence and needed governance to come on, I would guess that it would not pass. But if you wanted to come on and build an equity exchange, that's exactly the type of use case that we're looking for. It's important to know that, again, this network needs to be a good control location, right? It always needs to be up. It can never go down. And that's important in an environment where I talked about the generic blockchains. And, we've all seen instances where some of these generic multi-purpose blockchains will get overly stimulated, overly crowded, and they'll go down in the middle of a trading day for 5 hours. And that's a big deal, right? If a custodian bank or a broker went out of business for 5 hours in the middle of a trading day, their stock price would plummet. The blockchain networks, that doesn't seem to happen. Users don't really seem to care. They don't punish the coin price. And that tells me that no one is thinking about most generic public blockchains as a good control location. Times of high volatility is when you want to access them the most. Times of high volatility is when networks tend to go down. So everything we do is around risk, good control location, again, but no bankruptcy risk, because if the foundation ceased to exist tomorrow, the protocol developers, the validators would still go on without us.
Well, thank you so much, Anthony. I wish we had more time. That's all we have in terms of, we're going to have to close now. Thank you to Anthony and to Provenance Blockchain Foundation for joining us today. It's been a thoughtful and engaging presentation and Q&A, and really an update for the tokenization of real-world assets, the ecosystem around it, and all the additional considerations that you're working on. And we really look forward to learning more about the progress of Providence Blockchain Foundation. A recording of this presentation will be circulated to all those who registered and also shared publicly on GBBC's YouTube channel. Thank you, everybody, and have a great day.
Thank you. Thanks, Dana.